Warren Buffett is widely considered one of the greatest investors of all time. His impressive track record has made him an investing legend. But what are the key principles behind his investment philosophy? Here are 7 core rules that Warren Buffett lives by when it comes to investing. Rule 1. Invest in high-quality managers. One of Buffett's top criteria is the quality of a company's managers. He looks for managers that are passionate, talented, ethical, and think like owners. Buffett prefers managers who are rational, disciplined, and focused on creating long-term value rather than short-term gains. He avoids managers who lack integrity or talent. Identifying skilled managers is critical for Buffett. Rule 2. Base decisions on facts and data. Buffett stresses basing decisions on cold, rational analysis of objective facts and data. He avoids making investment choices based on emotions, hype, or gut instinct. Buffett gathers as much factual information as possible and analyzes it dispassionately to reach logical conclusions. Staying disciplined and unemotional is key. Rule 3. Favor wonderful businesses. Buffett targets outstanding companies with durable competitive advantages and high returns on capital, which he calls economic moats. He prefers simple, easy-to-understand businesses with predictable earnings, loyal customers, and limited capital needs. Buffett avoids highly complex or cyclical businesses. He invests for the long haul in companies with strong fundamentals. Rule 4. Only invest in what you understand. One of Buffett's most famous sayings is, "Never invest in a business you cannot understand." He avoids investing in overly complicated companies or technologies that are out of his circle of competence. Even if others are excited about something he doesn't grasp, Buffett will not invest. Sticking to what you understand is a cornerstone of his approach. Rule 5. Act decisively when you see value. Buffett moves quickly and decisively when he spots a great company trading at an attractive price. He does not hesitate or second-guess himself. Buffett recommends having a prepared shopping list of companies you'd love to own at the right price. When market turmoil strikes, you can act fast to pick up bargains on your list. Rule 6. Hold for the long haul. Buffett's preferred holding period is forever. He focuses on the long-term fundamentals of the businesses he buys. Buffett does not sell due to short-term problems or stock price volatility. He stays patient and gives companies time to realize their potential. Selling is only warranted when the fundamentals deteriorate. Otherwise, Buffett holds through ups and downs. Rule 7. Insist on a margin of safety. Buffett always wants to buy stocks substantially below his conservative estimate of their intrinsic value. This margin of safety provides a buffer against mistakes or unforeseen issues. Buffett prefers to pay 60 cents for every $1 of value. Without this discount, he feels there is too much risk. By insisting on an appropriate margin, Buffett sets himself up for solid gains. In summary, Buffett's approach focuses on high-quality companies, wise managers, long holding periods, decisiveness, comprehension, and buying at rational prices. Follow these 7 rules, and you can be well on your way to emulating Buffett's investing success. If you found this tips helpful, please like this video and subscribe to our channel. We're dedicated to bringing you wisdom and advice from leaders like Warren Buffett to help you achieve financial freedom and a life of lower costs and greater value.